Welcome back to another episode of Life Insurance Exposed, where we break down all the BS and show you the fine print that your cash value life insurance agent does not want you to see. My name is Jonathan Aguilera, and today we are breaking down how to read an indexed universal life insurance policy. Now, check this out, guys. I've been licensed since 2012, maybe? I think 2012. And let me tell you something. I never knew what all the numbers and all the charts meant in these IUL policies. And what's crazy is these products are supposed to be quote unquote conservative or safe, but that couldn't be more further from the truth. These are the most complex products that the American consumer could even buy. Check this out. There's people that have a life insurance license, they even have a securities license, that don't even understand how to break down these products. So if the financial professionals with the credentials are struggling to even explain these products to the consumer, then the people that are buying these products, do you think they actually understand how to read their contracts? Because you know, on the policy it says, read your policy, read your contract before you sign. And the truth of the matter is, these products are sold based off trust, right? They're being sold to people, and the people that are buying them, they're just signing because it's their brother, it's their sister, it's their mom, their dad, their uncle, their best friends. It's that person from church that are selling them these products. So they're not reading through that big stack of paperwork. They're just signing freely, and their financial futures are being devastated because what I'm about to show you is going to be mind-blowing. So let's dive into it. Okay, so here we have an index universal life insurance policy through National Life Group. So I'm going to teach you guys how to read this. So they're paying $300 a month, and this is just an illustration for $350,000 of life insurance, okay? These are the living benefits, so chronic, critical illness, critical injury, okay? Now, here's something I really want you guys to understand. These are called defined benefits, right? The living benefits are called, they're called negotiated benefits. Defined benefits are going to be your life insurance, like that's defined. They're going to tell you exactly what they're going to pay out, heaven forbid you pass away, okay? Your living benefits are going to be a negotiated benefit. It can be up to, right? Up to. So doesn't mean that's what they're actually going to pay. And I'm going to break that down, okay? So let's continue with the policy. So on this page, I want to focus at the bottom right where it has the guideline level premium, the single premium. Let's focus there, okay? And I think this is where it's so important to understand. The guideline level premium, whatever number that is on your IULs. Okay, so in this scenario, it's 14,617. What the heck does that mean? Whatever that number is, that is the most money a client can put into this policy for it to be considered max funded. So whatever that number is, now that number is going to change the bigger the death benefit gets. So if in this case it was 350,000, so if they had a 375,000, then that guideline level premium number would go up. If it was a $500,000 death benefit, then that guideline level premium would also go up. If the face amount was 100,000, then that guideline level premium would go down. Okay, so that moves up and down with how much life insurance they have, also with the age of the client. Okay, so whatever that is divided by 12, that's how much this client needs to be paying in order for this policy to be considered max funded. So you could already tell that for this particular illustration, it's only $300. Well, 300 times 12 is only $3,600. So this is nowhere near being max funded because they need to be putting $14,617 into this, okay? Then we have the guideline single premium. So that's $77,000 for this particular policy. So whatever that number is, what that means is that's the most they can put into the policy upfront, single premium, one time. They can't put any more money into this policy for the next 6 years. So on year one, 77,834 or whatever that number is for that policy. The next 6 years, zero premium. They can't put no more money in. So then on year 8, they can go ahead and start funding back to the guideline level premium, okay, if they want to continue to put money in. So that's what that is. Maximum non-MEC premium, you rarely see people use this number. So I'm not even going to go over that. You'll primarily see those first two numbers. And if we were to look at that target premium, okay, that target premium, where it says 3,397, okay, that is the number the agents get paid off of, okay? If the agent's at a 50% commission level, right, they're gonna get paid 50% off that 3,397 bucks. If they're at a 90% commission level, they're gonna get paid 90% off that 3,397. So that's a big commission. That is a huge commission. So now that we understand what those mean, now you can go ahead and decipher whether something's properly structured and max funded. So let's teach you guys how the indexing crediting methods work. So right here we have 1, 2, 3, 4, 5. There's 6 indexing strategies you can choose. So we have the US pay setter, we got the balance trend, and we got, looks like 4 S&P 500 options, okay? So if we were to look at the current cap rate and then a guaranteed cap rate, and then we have a current participation rate and guaranteed participation rate. What the heck does that mean? Okay, I want to focus on the S&P 500s first. So the current cap rate, what that means is what the insurance carrier is going to give you right now, whatever that number is. That is the current cap rate when you buy the policy. So today is March 12th, 2026. If I buy this policy today, that would be my current rate, my current cap rate. So if I chose that S&P 500 with the index loan account, 9.50 is going to be my current cap rate. If I chose the S&P 500 point to point, that's going to be 11%. So that's my current cap rate, so forth and so on, okay? The guaranteed cap rate, okay, what that means is at any point in the policy, at any time frame in the policy, the insurance carrier can drop my cap rate from 9.5 or 11% or 8.25 or 8.50 down to the bottom number, which means 3.10 or whatever that number is. So they can lower them. Now, they are going to lower them, especially National Life Group. Do I think they're going to lower them all the way down to 3%? No, right? They could if they wanted to. That's the guaranteed lowest they can do, whatever that number is. I think they will lower them to about 5, 6. I have in-force illustrations of National Life Group cap rates of about 6%. So they will lower them. So that's the insurance carrier's way of telling you, the client, that they could lower your rates, okay? Let's talk about participation rates. Whenever you are trying to communicate how a participation rate works to a client, I always want you to use the number 10 because it's easy to do the math. So if we were to look at the US pay setter and it has a 260% participation rate, okay? Always use 10. So if the US pay setter gives us a 10% return, they're going to give you 260% participation of 10. So what the heck does that mean? I just want you to take that decimal point right after the 0 and move it over one time to the left, which gives us 26%. So if the US pay setter does 10, the insurance carrier is going to credit you 26%. Sounds like a deal, right? Same thing for that balance trend. They're going to give you a 240% participation rate. So if it returns 10%, they're going to give you 24% credit. Okay? So that's how you read that. That's the current rate. Well, guaranteed means they can lower them to 50%. and they will lower them, especially these two. And I'm going to go over what those two are. So if they lower it to 50%, that same 10%, if the US paysetter or if the balance trend returns 10%, you're only going to get 50% of that, which is 5. You'll just move that decimal point over once to the left. So instead of getting 10, you're only going to get half of that. That's what that means. That's what they guarantee. They can't go any lower than that. Okay? Whenever you see a no cap or uncapped, this is their favorite saying right here. Oh, we have uncapped strategies. You know, you can make as much as you want with big participation rates. Those are called volatility controlled indexes, proprietary indexes, which are fake. They're made up. They're not real. Okay, and I'm going to make a whole video on that, on volatility controlled indexes. But these things never perform. They're practically made up of bonds and cash and fixed income instruments, where like the US Paysetter, you guys can literally just Google it. Like, what has the US Paysetter returned since inception? I think it's like 3% since 2000. So it's terrible. Like, it's a bond-driven performance index. At the bottom, where it says maximum illustrated rate, where it says 6.81, 6.81, 5.5, okay? That is the interest that they can use on the illustration. Okay, so I want you to think about this from a sales standpoint. What's going to look better on paper? Choosing an indexing strategy that shows 6.81 or 5.50? Which one's going to illustrate better on paper? Which one's going to look better on paper? Okay, so there's only 3 options. We have one S&P 500 cap to cap or cap focus, and then we have 2 volatility controls. Okay, so a lot of these agents, what they'll do is they'll choose like a US Paysetter because it's uncapped with a 260% participation rate. It's easier to sell. It's more attractive. It sounds sexier than saying, oh, you're only going to make up to 11%. So they'll use the US Paysetter many times as the crediting strategy, and that volatility controlled index just never performs. So now that we're reading the illustration, don't ever use the guaranteed illustration, the guaranteed values, because you would be lying. The reason why you never use the guaranteed values is for this reason. The guaranteed values are assuming that the insurance carrier is going to charge the maximum fees and cost of insurance day one. And little side note here, no insurance company in the history of insurance companies have ever charged the maximum cost of insurance. So that's already false. 2, the guaranteed values is assuming that the indexing strategy, in this case I chose the S&P 500, that the S&P 500 is going to return 0 every single year for 30, 40, 50 years. Now guys, has the S&P 500, is it going to do 0% for 40 years? No. So that's what it's assuming. So if you're going based off the guaranteed illustration, you're also misleading. So that's why you never want to use it. Okay? So you always want to go over the alternate current values and then the current values. So we want to talk about the current illustrated values or the alternate current illustrated values. Okay? So current illustrated values is going to be best case scenario, which will never happen. It'll never happen. And then the alternate is going to be a lower interest rate. In that case, you can see on the left where it says 3.5%. I believe on a max funded, properly structured IUL, it's going to do somewhere right in the middle between the alternate and the current. Okay. So if we were to take a look at the cash value, they put in 3,600. Obviously, this is not properly structured, so there's a couple zeros, and you're going to see the difference on a max funded policy, which I'm going to show you right now. So this is the exact same death benefit, the same guideline level premium, $14,617. And if you were to look at the top, we still have a $350,000 death benefit. But if we were to look at the illustration now, we have no more zeros. because we're putting the whole guideline level premium, we're putting $14,600. So we have $7,000 of surrender value versus zero. That's what a properly structured IUL would look like, but you're putting a ton of cash. So it's going to lead me to my next point on the living benefits. So living benefits, very controversial topic right now, very hot topic, and I want to break this down to you. So when people say it has to be max funded, you know, they're always talking about max funded, max funded, max funded, max funded. Well, that's going to affect your living benefits, or it's going to affect your death benefit. So I always like to tell people, when you buy an IUL, if you get it for cash value, you're going to sacrifice living benefits and death benefit. If you buy an IUL for death benefit and living benefits, you're going to sacrifice cash value. So here is something called a corridor percentage or a corridor gap that the IRS has set for 7702, which is, you know, these guys' favorite thing to talk about. And you guys can just Google this, just type in what are the corridor percentages for permanent life insurance and it'll tell you. So between ages 0 to 40, okay, you must have 250% more of death benefit to cash value. So these are all the percentages, 45, right, whatever. And I'm going to break this down. So if you have $100,000 of cash value, you must have 250% more in death benefit. So you must have a $250,000 death benefit. As you get older, you can see how that percentages go down. So if you're 45, you don't need to have as much. And this is lowering the net amount at risk. If you don't know what that is, I'll do a whole video on that. By the time you're 50, you only need to have 185%. So if you only had $100,000 of cash value, you're only required to have $185,000 of life insurance. Because of this 185 grand, 100,000 of it would be cash value. So really, you're only paying life insurance on 85 grand. Okay, by the time you're 75, you only have to have 5% more. So if you have $100,000 in cash value, you're only required to have 105,000 of death benefit. And then obviously you would switch it to level so it becomes one, right? You change, you can control that. That's what they'll do. They'll start it through increasing for all your funding years, and then they'll switch it, okay? Why am I bringing this up? This is so important to understand. These percentages must always remain. They must always remain. So let's say you're 60 years old, okay? You have $130,000 of life insurance. You have 100 grand of cash value. That means there's only really 30,000. There's only $30,000 of actual life insurance, okay? And then you take a living benefit claim. Well, they're gonna draw it from the death benefit, but remember, they're gonna draw it from the death benefit, but remember, we still need to have 130%. That gap still must remain. So let's say you're at 60, okay? And you have a living benefits claim. Well, you need to have at least 130% of death benefit. So if you have $100,000 in cash value, you have to have at least 130 of life insurance. So that's only $30,000 more of life insurance for it to qualify for this corridor gap. Let's say you have a living benefit and you withdraw 50, you accelerate 50,000. So that means you only have $80,000 of death benefit left. Let's just assume that's how it works, okay? Well, we must reduce the cash value as well because we must have 130%. So this can't stay the same. So let's just do some math. Okay, let's say we have 50,000 of cash value, 1, 2, 3, and then we're going to times that by 1.30 because that's how much life insurance we need above our cash value. Nope, that's only 65,000. We have 80, so we could probably have a little bit more. So let's do 60,000, 1, 2, 3, and we're going to times it by 1.30. So we're close. Okay, we could probably have about 62,000. Boom, 61 something. Right? We could probably have let's just call it $61,000. Okay, that's what they're going to reduce our cash value. So I want you to think about this. You accelerated 50,000 for a living benefit, but of the 50,000, almost 40,000 of it was your own money. It was your own cash value. Only 10,000 of it actually came from the death benefit. Oops. Right? Got to put that back. Like, how is that a benefit when you literally self-insured your own living benefits? I'm not knocking the living benefits here, but I'm saying this is how it works in cash value life insurance, especially in the IUL. So if we are concerned about living benefits, they should 100% be in term life because they only can take it from the death benefit itself because there's no cash value. I hope you guys caught that right there. Okay. Now, kind of going back to this whole properly structured, max funded. Okay. 99% of these policies are not max funded, so it's not going to look anything like this, nothing like this, which means they're not going to have any cash value, which is going to screw them long range, which is probably going to end up in a policy lapse. So I want to go ahead and show you one last thing, especially when we're talking about policy loans. If we were to look at this chart where it says hypothetical returns by strategy, you know, if you would just use some common sense here, if we're going to start using loans, and let's just say it's 5%, that's what the loan is, okay, for tax-free income during retirement. And it's funny how they started in the year 2005, but if we were to go back to the year 2000, you see how bigger of a problem this is. So on the S&P 500 point-to-point growth rate, all right, that shows you what the S&P 500 price return did. Remember, it's tracking the price return. So we talk about sequence of returns risk. So if we start in 2005, we're actually going to go back to 2000, but let's just start from 2005. I want you to think, this is what the illustration never shows, okay? If we start taking income via loans and we stop putting premiums into the policy, what we're essentially doing is we're adding an additional fee, or we're adding cost or net amount at risk into the policy that the illustration isn't showing, okay? So let's go to 2005. If we took a 5% loan in the year 2005, we only got an interest credit of 3, which means we're negative 2. So that is a negative year for us. That means we're negative 2% because we took a loan out at 5, we only got a 3% credit, we're short. Just because we stopped putting money into the policy doesn't mean the cost of insurance and the fees disappeared. They continue to come out, okay? So that's going to start eating at the cash value. 2006, we're fine. 2007, boom, another one, right? We don't get enough credit. So that's a negative year for us. So that's already 2 negative years. 2008 would be 3, okay? 2011 would be 4 negative years because remember, we're at a 5% loan. Okay, so that's 1, 2, 3. Yeah, hold on. 1, 2, 3. No, that's 4. Okay, 4. And then 2015 would be 5. 2018 would be 6. All right, 2022 would be 7. Okay, 7 negative years in our tax-free retirement. If we were to go back to 2000, so the year 2000, 2001, and 2002 would be all negative years. So that would bring us to 10, or I think 11, because I think 2000, 2001, 2002, I think 2003 or 4, I think those were positive years. So we'll just say 10 negative years in a 24-year time frame. 10 negative years, okay? So if we were to do the math on that, let's do the math. Let's get our calculator out. 10 divided by 24, that is 42%. 42% of the time, we're going to have a loss in our policy because there's not enough interest credited to sustain the policy. So that brings a massive, massive red flag for anybody who's trying to use index universal life insurance as a tax-free income source every single year. Every single year. Okay. And we're not even talking about the cap rates reducing, like the caps. Like that is really the killer right there, is when they reduce the cap rate. If you found value in this video, make sure you subscribe, you like, you share, hit all my buttons. You know what to do. And let's get you guys dialed in, baby. Let's get you guys dialed in so you guys can be more effective and efficient, so you guys can go ahead and serve the American consumers properly. See you guys on another episode of Life Insurance Exposed.